Does quantitative easing cause inflation risks? Have you ever wondered how the actions of the Federal Reserve can impact inflation? Today, we will look into the relationship between quantitative easing and inflation risks. Quantitative easing is a unique monetary policy tool used by central banks, including the Federal Reserve, to stimulate the economy. This policy involves purchasing long-term securities to increase liquidity in the financial system. The goal is to lower interest rates and encourage economic activity. When the Federal Reserve implements quantitative easing, it increases the money supply. This added liquidity can make borrowing cheaper, which can lead to increased spending and investment. As demand rises, it can sometimes outpace supply, resulting in higher prices. This is where inflation risks come into play. Research indicates that the inflationary effects of quantitative easing can be more pronounced than traditional monetary policy methods, like adjusting short-term interest rates. In fact, studies have shown that the inflation impact from quantitative easing can be 2 to 4 times greater than that of conventional policy easing in economies such as the United States and the United Kingdom. This is largely because quantitative easing directly influences long-term interest rates and asset prices, which in turn affect spending and inflation expectations. However, it is important to note that the inflationary effect of quantitative easing is not a certainty. The outcome depends on the economic environment. For instance, during a deep recession, quantitative easing can help raise inflation towards target levels by stimulating demand. Conversely, if the economy is already near or at full capacity, quantitative easing may lead to overheating and rising inflation. The transmission of quantitative easing to inflation also involves the lending activities of banks. By increasing bank reserves, quantitative easing encourages banks to lend more, which supports business investment and consumer spending. This can further push prices upward. The Federal Reserve closely monitors inflation and may use tools like quantitative tightening to counteract any inflationary pressures that arise from quantitative easing. For example, after expanding its balance sheet through quantitative easing, the Federal Reserve has engaged in quantitative tightening to reduce excess liquidity and help manage inflation. In summary, quantitative easing does carry inflation risks because it increases the money supply and stimulates demand, which can lead to higher prices. The extent of these risks is influenced by economic conditions, the scale of quantitative easing, and how the Federal Reserve manages the policy over time to balance economic growth with inflation control.